Mr. Tarun G. Arora, the CEO at Zydus Wellness. Tarun, hi, morning, and thanks so much for your time. First of all, we understand that so far in FY26, unfavorable weather conditions have tempered category demand for names like Nycil and Glucon-D. This is something that you've mentioned as well. With summer this time expected to be hotter and longer, what's the outlook on recovery in your summer portfolio, particularly these two brands?
So thanks for having me. My pleasure being on this platform each now is doing wonderful. We've had a difficult summer in 2025, and it absolutely impacted a lot of our plans. But because we have these couple of brands, Glucon-D and Nycil, which have a higher index to summer. Now, 2026, people are talking about a longer and a deeper summer. So that's good news in a way that we do expect that it'll help all the summer brands, including Glucon-D and Nycil, to reach out to more consumers. In any case, we do see there is a clear trend towards, if I talk about Glucon-D, there's an energy and hydration are overall overarching trends where we are very well placed. And as we move forward, we're looking at not just building Glucon-D as you've known for decades, but also new innovations that we have launched in last few years, and a couple of the ones which we are going to roll out this year. They should help us build a larger business model, more relevant to the changing consumer needs as we see evolving over a period of time. Similarly, Nycil, again, as the consumers are seeking more from what they were used to, I think it's going to be meeting those needs as well. And a great summer will be good news for us. Having said this, there is a certain level of movement for these brands beyond the peak summer, and therefore they're getting evened out. So that will be anyway a good way to look at how we build 2026 for us.
Interesting. But Tarun, based on how categories like hydration and everyday wellness are performing, is this a season signaling a stronger second half or a more value-conscious consumer than markets are currently pricing in?
The way I look at it is that second half of the year should obviously get better only as the demands get better and the base effect also kicks in. Consumers are getting more value conscious on one side because there are larger consumers opportunities. Similarly, people are ready to pay a lot more if they see a good value and a good innovation, because today what existed earlier is getting challenged with new age products, new age innovations, some of them coming from smaller players. But we ourselves are also looking at what is the consumer going to be seeking. And therefore, there will be a little bit of shift which may seem smaller in a short term, but over a medium term will build into a larger trends where consumers will switch to newer formats and newer experiences as they move along, even in energy and hydration.
Okay, and let's talk about the focus on wellness as a segment. A lot of your peers are doubling down on investment in wellness as a growth engine via acquisitions. Now, when you look at your portfolio, you're already very optimally positioned here. Are any inorganic growth opportunities on the cards soon? Are you looking at acquiring a few D2C companies? Because that is what the trend has been among the listed space so far.
So, look, a lot of companies have had to pivot themselves to get into more wellness, more science-based products, because some of their products needed to, or some of their businesses needed to move in that direction. Fortunately, the basic build of Zydus Wellness has been science-based innovations for a long period of time. And most of our products that we have either built in-house, innovated, or acquired have been focused around the trends which are very relevant to consumer health and wellness. And therefore, I think we are fairly well built, ready for the future. Having said that, we do see some opportunities which will keep coming up, things that we may take time ourselves to innovate on. Or there is something very interesting which has come up from some new age players. We are very happy to embrace and take that on. And therefore, our work on acquisition piece keeps going on. it could be a D2C or a sizable brand, but as long as it fits into our wish list of where we want to play, and we've clearly identified one side is of course food and nutrition, where we've been strengthening across energy, hydration, protein, etc. Similarly, on the personal care, where we have a very focused functional skincare, and we've also now started marketing the hair color piece also, which our doctor recommended. So the way we are looking at it is building a portfolio which is very suitable for the consumers. And if something does come in our way, we'll be very happy to take that on.
Right, interesting. But you've amped up your focus on themes like protein, health, wellness, nutraceuticals. Tell me which categories you think are growing the fastest and what kind of growth trajectory can one foresee for these segments?
So I think we're seeing fairly exciting growths in the protein space, because what's happening is it's been for a while that people have talked about, that the country is protein deficient. But the fact is that there is a lot of, should I say, tailwinds, which are supporting the fact that people want to eat healthier. And protein obviously provides a good way to just improve your everyday, food. And therefore, we see protein is clearly a very high growth momentum that we see in that space. Similarly, and not just in India, but global level also, there is a good momentum around the vitamins, minerals. Our acquisition in Europe, which is focused on the VMS space, that lends very well to this space. Both in Europe, we are getting into US markets as well. So we obviously see these, the focus on health, both from macronutrients as well as micronutrients. And some of our innovation, like we've launched VMAX, which is focused on adult nutrition through better protein, using better probiotic, prebiotic mix. Our Max Protein business, which we are very excited about because it brings protein through everyday, snacking. So some of these products are really going to be participating in this momentum that we see from a consumer side.
Okay, and also about your growth overall, if we take a look at how that is shaping up, if you could throw some light on how your recent growth is being shaped up. Is that being driven more by volume expansion, better mix, or is pricing at play? And talk to us about how sustainable this is as input costs and advertisement spends rise as well. And while we're at it, also give us your view on where you think input costs are headed ahead.
So that's a lot of questions. So let me just break it down from first growth part of view, and then on the input prices. I think from Zydus Wellness's point of view, what our focus is to build a growth engine which the market can trust, which is more, should I say, structural or systemic in nature, rather than more episodic. We have a good season, we'll grow, and those are very exciting brands, very exciting spaces. But we want to go beyond the fact that we are almost dependent upon having a good season. So clearly our growth momentum, the way we are looking at is have those broad five spaces that we want to play: energy, hydration, sweeteners, protein, dairy and spreads, functional skincare. Each of those spaces clearly have their own space. There is a core where we've built our businesses, but go beyond the core, get into new categories where we have a leverage of the brand and build around it. And therefore, to my mind, some of the innovations and acquisitions that we've integrated together will lend us to a good double-digit trajectory over medium term on a consistent basis. A little bit of quarter to quarter or seasonal impacts will happen, but at an overall level, we are well prepared for that future. Now, to make this work, we need to invest because we are practically market leaders in many of the spaces we've got ourselves into, plus market making for some of our new innovations. That means that we have to spend a little bit ahead of the market, which is about 13-14% that we spend on marketing spends. To get that right, we need to have a stronger gross margin pipeline, and therefore we keep a very close tab on what is happening on the input cost side, and therefore able to pass it on if there is a challenge there. And therefore, the way I look at it, input costs are, I mean, there will be always some level of volatility, but it's far more stable, far more predictable today than it was 3-4 years back. And therefore, you will see there is a consistent improvement in our gross margins over last 2 to 3 years. Nothing significant, but a consistent quarter over quarter, we have been able to move up our gross margins, which is giving us an opportunity to invest back into growth and build up a more sustainable growth and a bottom line trajectory. So that's the kind of spiral that we expect to play out for our business, where we build new innovations. We have products which have tailwind, which are built for the future. We do them in a profitable way, invest behind market making, and hopefully have some money, which is more than earlier for our shareholders as well. So that's largely the broad approach we would expect to take.
Right, understood. Tarun, great to have you today on ET Now and getting all that insight on where the business is headed next.
Thank you. My pleasure.
Okay, let's shift now from wellness to auto